talk about the way forward. Jigar Mistry, co-founder of Buoyant Capital, is now with us. Jigar, the market rally that we've seen over the last 3 or 4 months has taken everyone by surprise. At the beginning of the year, we'd asked all the market experts, how do you think this year is going to pan out? And they all said, well, the first half is probably going to be flat and maybe we will see some returns coming through in the second half of the year. So this rally, literally took everyone by surprise. No one was anticipating this up move that we've seen of nearly 20% in the last 4 months. Now, the question is, where do we go from here? Your thoughts?
Yes, good morning, Rima. Thank you for inviting me to your show as always. Now, if you sort of call any of those participants again, I doubt anybody would really be complaining, right? So everybody is happy that the markets have returned the way they have. But I think from where we are looking at it, I think there are two broad schools of thoughts. The first is what sort of we call, central bankers are God scenario, where, it's sort of, if you break it down, it seems something like this, that economics is an exact science. Central bankers have managed to raise, interest rates just enough so that the economy slows down, but does not really collapse. Inflation is a funny concept because say 100 rupee item goes to 120, that's a 20% inflation. 120 stays 120 next year, it's 0% inflation. So for inflation to come down, prices don't really have to be cut. And economy will slow down, sort of not go into recession, inflation will slow down, and obviously India is the next big thing. For FIIs, there is very limited space to invest. Domestic investments also, there is no alternative other than equities. So I think reprice everything now, right? That is one scenario which we are seeing. The other scenario really is what we call nobody ever knows anything scenario, because economics is not really an exact science, right? Economics take time to readjust to the things that have come through. And when interest rates are hiked in quick succession, you have a scenario where, there's skeletons in the closet waiting to tumble out. And effectively, see, US was the parking currency for most global savings. And therefore, US didn't realize the inflation was such a big problem. And now they are seeing it because there is a regionalization of national savings. China is dealing with in yuan with a lot of economies. India is doing the same thing. Now, what is the market pricing in between those two scenarios of the sort of 1280 companies with more than 500 crore market cap? Some 50% of the stocks are up 30% or more. 25% stocks are up 50% or more. And some 60 companies have doubled within the span of the past 4 months. Right? In that time, Nifty is up only 16%. Now, the point to remember is that this is not 2021. At least in our opinion, it is not, because 2021, you had companies which were really hungry. They saw, post-COVID to be once in a lifetime opportunity, and many of them were gunning to change the landscape. Number two, monetary policy was decidedly loose. And thirdly, there was a lot of fiscal space. I think all the three ingredients that led to 2021 are today not really present. And assuming scenario B is not really a zero probability event, at least we are turning a lot more towards large cap. In fact, what we classify as core, which is large cap and low beta, is now up to 64% in our portfolio versus 54 just over a month ago or so. And similarly, small and mid cap allocation is down 14 percentage points over the course of the last month. So I think it's good that all of us are rejoicing the past 3 or 4 months, but it's time to at least look at what the fundamentals are pointing towards rather than just the liquidity.
Okay, so since you are sounding out a bit of a cautionary note here, Jigar, tell us, if you want to take profits, tell us which are the parts of the market that perhaps are looking a little frothy to you, where you would advise profit taking?
A lot of them, Surabhi. So good morning to you as well. See, generally, if you look at the earnings trajectory, there are parts which have, continued to disappoint. Clearly, consumer staples is one such place, discretionary is another. Automobiles haven't really had such a good result. I think barring sort of financials, NBFCs, and to certain extent, your engineering spaces, you don't really have a lot of opportunity where things are looking all that bright from an earnings standpoint. And obviously, Nifty valuations have always been higher relative to the regional markets, and given the flows, things have also continued to remain reasonably good. But I think rather than sort of booking it all out, I think a lot of focus had shifted towards the small and mid cap space. And even if you want to, protect capital a little bit, the better way to approach this is through large caps rather than just the small and mid caps, is what we believe.
Okay, got that. Jigar, thanks for joining us. But at a time like this, with the earnings season halfway through, are there pockets which you're also feeling like maybe, it's now a good time to put money into spaces? There have been, the pharma pack, for instance, right, which came as quite a positive surprise. Do you think those pockets still look attractive, even if you're looking at the large cap names within these?
Yes, good morning, Pavitra. So yes, I sort of agree with that. In fact, I remember our interaction in April, and we even put out a note during that time that pharma generics is a space which looked very attractive back then. Home textiles, hotels, those places are clearly the areas where, increasingly you are finding some amount of comfort. Non-large cap IT space is another space that we continue to like. Smaller banks, so we have always discussed banking, but within that, the order of preference needs to be looked into, right? So, sort of smaller banks is a place where you see, everything else being okay. So, credit growth cycle, NIM cycle, and credit cost cycle being benign, there was a lot of valuation catch up that needed to happen. And that has happened, but that doesn't mean most of these banks are not really worth investing at a larger point in time. So I think there's space clearly to look into, but with barring this, this, if you combine all of this, this is not really a very large proportion of the frontline indices. The combined, this will be like 20-22%. So still a vast majority of them, which is the consumer, IT, oil and gas, those spaces are not looking all that attractive.
And I remember last time you had also spoken about Welspun India because of lower cotton prices, and that stock has done so well. We were chatting with the management today, and they're holding on to their guidance of 10 to 12% top line growth, and the stock is up 4.5% today and nearly 50% since the beginning of the year. So you've got that call bang on, Jigar. Thank you very much for joining in. Need to get into a break. We'll come back and chat more on the market. Stay tuned.